Investing can be a powerful tool for building wealth, but it's essential to avoid common pitfalls that can derail your financial goals. Here are some common investing mistakes to watch out for. 1. Not starting early. One of the biggest mistakes investors make is delaying their investment journey. The earlier you start investing, the more time your money has to grow through compound interest. Compound interest is often referred to as the eighth wonder of the world. It's the interest you earn on your initial investment plus the interest you earn on that interest. Over time, this compounding effect can significantly boost your returns. Imagine you invest $10,000 at a 10% annual interest rate. After 1 year, you'll have $11,000. In the second year, you'll earn 10% interest on the entire $11,000, not just the original $10,000. This means you'll earn $1,100 in interest, bringing your total to $12,100. As time goes on, your earnings will continue to grow exponentially. By understanding and leveraging the power of compound interest, you can significantly accelerate your wealth-building journey. Remember, time is your ally when it comes to investing. Remember to hit subscribe for weekly wealth creation tips. 2. Fear and greed. Emotional investing can lead to poor decision-making. When the market crashes, fear can lead investors to panic sell their assets, locking in losses. Fear can prevent investors from taking advantage of buying opportunities during market downturns. Greed can lead investors to overpay for stocks, especially during market bubbles. Following the herd mentality and investing in hot stocks can lead to poor investment decisions. Try to detach yourself from your investments and focus on the long term. By understanding and managing these emotions, you can make more rational investment decisions and increase your chances of achieving your financial goals. 3. Ignoring fees. High fees can significantly erode your investment returns. Choose low-cost investment options like index funds or ETFs. Index funds track a specific market index, such as the S&P 500, and typically have lower expense ratios than actively managed funds. You can also use discount brokers. Online brokers often offer lower trading fees than traditional brokers. Some funds may have hidden fees, so it's important to read the prospectus carefully. By understanding the impact of fees and taking steps to minimize them, you can significantly improve your investment returns and achieve your long-term financial goals. 4. Overtrading. Frequent buying and selling of stocks can increase transaction costs and reduce your overall returns. Focus on long-term investing and avoid impulsive decisions. By investing in quality assets and holding them for the long term, you can benefit from the power of compound interest. 5. Not diversifying. Diversification is a fundamental investment principle that involves spreading your investments across various asset classes to reduce risk. By diversifying, you can minimize the impact of poor performance in any single investment. Putting all your eggs in one basket is risky. Diversify your investments across different asset classes to spread risk. Example of a diversified portfolio. Stocks, a mix of large cap, mid cap, and small cap stocks. Bonds, government bonds, corporate bonds, and municipal bonds. Real estate, investment properties or real estate investment trusts, REITs. Commodities, gold, silver, oil, and agricultural products. By diversifying your portfolio, you can create a more resilient investment strategy that can weather market fluctuations and economic downturns. 6. Ignoring taxes. Understanding tax implications is crucial. Take advantage of tax-advantaged accounts like IRAs and 401ks. 7. Failing to rebalance. Over time, the balance of your portfolio may shift. Rebalancing regularly can help you maintain your desired asset allocation. 8. Chasing trends. Investing in hot stocks or chasing the latest trends can be risky. Stick to a long-term investment strategy and avoid impulsive decisions. 9. Not seeking professional advice. If you're unsure about investing, consider consulting with a financial advisor. They can provide personalized advice and help you create a customized investment plan. By avoiding these common mistakes and adopting a disciplined investment approach, you can increase your chances of achieving your financial goals. I hope this video helps you in being one step closer to your financial goals. Please give a thumbs up on the video if you have enjoyed watching. If you have any questions, please leave them in the comments below. And be sure to subscribe to our channel for more wealth creation tips. Bye!